Did you know that 82% of entrepreneurs fail because they simply run out of cash? Did you know that? Did you also know that they can learn the true financial health of their business by looking at one financial statement? And it is not your income statement, it is your balance sheet. Did you know that as well? Well, here's the thing, everyone focuses heavily on their income statement. And granted, it does show you your income, your revenue, your expenses, your net profit, your net loss for a specific period of time. But your balance sheet actually identifies the financial health of your business for a specific point in time. Let's talk about it. Welcome to the Say Yes to Profits podcast. Here's where you will learn how to manage and master your finances so that you smile when you log into your bank account. Say Yes to Profits is a full-service accounting, tax, and CFO firm. Our mission is to stop entrepreneur failure and create profitable CEOs. Tune in each week for new financial, business, and tax strategies. Listen, it is past time for you to say yes to profits. So let's jump in to this week's episode. Hi, everyone. Welcome back to another episode of the Say Yes to Profits podcast. I am your host, Octavia Conner, and I'm so excited to help you master your finances so that you confidently say yes to profits. Today, I want to talk to you about the balance sheet. The balance sheet is that financial statement that a lot of entrepreneurs are just not clear about. And so oftentimes they ignore it. And that is a huge financial mistake. You see, your balance sheet gives you a snapshot into the financial health of your business for a specific point in time. It identifies everything your company owns, its assets, and everything your company owes, its liabilities. And it's going to identify the equity, the worth that you have as the owner in the company, or the worth of the business. You see, your equity, and we're going to talk about that a little more in just a second, but it identifies the value of the assets that you have or that the company has after subtracting all of its liabilities. So do you see why your balance sheet is so important? Well, I want to get into all of this because I need you to really start looking at your balance sheet in combination with your income statement and your statement of cash flow. There are several videos here on my YouTube channel that identifies each of the financial statements and helps you really understand how to use all of them to your advantage. And so now we're going to focus on, again, the what? Let me hear you. The balance sheet. Listen, this podcast is about you and I talking together. So leave your comments. Let me know your questions. This is not just me talking to you. I want to hear from you because I want you to truly walk away understanding every single lesson that I bring you right here on the Say Yes to Profits podcast. So again, make sure you leave your questions, make sure you leave your comments, and let me know anything else I can teach you. Okay. So again, let's go into the balance sheet. Now, when you think about your balance sheet, right, and you're looking at your balance sheet, so at the very top, of course, is going to say the name balance sheet. But as I mentioned before, it is going to cover the financial health of the business for a specific period of time. So for example, the balance sheet may have December 31st, 2025. And so this is saying that the financial health of the company as of this specific point in time, December 31st, 2025, this is what you see that you own, that you owe, and that is the worth of the business. Understood? Yes, yes? Let me know in the comments. Let's move on. Now, your balance sheet is broken down into three categories. You have your assets, you have your liabilities, and then you have your equity. Okay? And so under each of these categories, there are certain line items that will tell you the total for each of these categories. Starting with your assets, you have your current assets, right? And your current assets are all of the things that are current as of within that year, okay? And so, for example, the first thing that you will probably see under your current assets would be your bank balance. So all of the bank accounts that you have, the balance will be listed more than likely first on your balance sheet. The next thing that you're going to have is your accounts receivables. Now, your accounts receivables means that you sent out invoices, but your clients and customers have yet to pay. And so there's an open invoice that you need to firmly but friendly collect on. That is going to be listed under your accounts receivables. Here's the thing about this. On your income statement, if you're using the accrual method of accounting, you may show that you have a net profit, right? And you're all happy and you're excited, but if they have yet to pay you, that money didn't transfer from that net profit to your bank balance because you haven't collected on the money. And see, that's one of the ways that entrepreneurs can be profitable on paper, but yet run out of cash because of accounts receivables. Now, the next thing you would have under your current assets is inventory. Inventory, I like to say, if it is a lot, okay, that means that you literally have money sitting on the floor. You have a warehouse full of stuff that you're not selling. Why? That means that you need to pick that money up literally, figuratively, physically too, off the floor and put it in your bank account, right? And so inventory would be under your current assets as well. Is your financial house in order? Meaning you have the ultimate financial visibility into every dollar that is entering and leaving your business. And so you have financial clarity, control, and you're operating from a place of financial confidence. If you're unable to say yes to this, you need financial strategies, systems, support, and solutions. And the only way to get that is to hire a virtual CFO. Well, I want to introduce you to my company, Say Yes to Profits. We will help you manage and master your finances so that you eliminate all cash flow problems, gain the ultimate financial visibility, and say yes to profits. Listen, I want you to click below and schedule your discovery session with me today. There's a reason why we have a 95% success track record. Click below and schedule your discovery session with me today. I look forward to speaking with you soon. Say yes to profits. The next thing you would have is prepaid expenses. Now, these are the expenses that you've paid in advance, hence prepaid expenses. They would be under current assets as well. Once you've listed all of your current assets, the next thing under assets would be non-current assets. Now, these are the things, just like it said, that are non-current. And so a couple of categories under here would be property, would be plant, equipment, trademark, and you also have patents. All of these would be listed under your current assets and your non-current assets, okay? And this is everything that you own. All right? So this is showing you the value of everything that you own. Got it? Got it? Yes? All right. So now we move to your liabilities. And the same with your assets, your liabilities, you also have current liabilities. Okay? Just like your assets. Now, under your current liabilities, you would have something called accounts payable. And so these are all of the bills that you need to pay in your business, right? Next, you will have short-term loans or debts. And so these are the loans and debts that are ideally due within that year. And so you could have under here, for example, your credit card. because that's due within that year. Make sense? Yes, yes. Next, you would have accrued expenses. Okay? And these are all of the categories under your current liabilities. Just like your assets, you'll also have non-current or even long-term liabilities, okay? And under here, you'll have a couple of different things as well. Number one, you would have long-term debt. So this is the debt that is, of course, due, but is not within that year. You may have a couple of years, like your vehicle or any type of other long-term debt. Next, you would have something called deferred tax liabilities. Okay. And so maybe you have some taxes due for your business that you're deferring out for the next couple of years. Then you would put that balance here under deferred tax liability. So these are the things that you will have listed under your liabilities. All right. So I want to bring this back to make sure you can hopefully see this. And so all of your liabilities, you all, are everything that you owe. Okay. And so your assets over here, everything that you own, your liabilities, everything that you owe. Understood? Finally, we come to your equity. Now, your equity is your claim or the business's claim on all of its assets after it has subtracted all of its liabilities. And so there are a couple of things that break down your equity. Number one, you may have something under here called common stock. And depending on your business structure, there are other things like you may have owners' contributions. You may have owners' distribution, all under your equity for your company. You may also have any other additional paid in capital. And then you're going to have also something called retained earnings. Okay, so these are the different categories that you will have on your balance sheet as of a specific point in time. All of your assets, everything that you own, all of your liabilities, everything that you owe, and your equity. What is left over of the assets, the claim, after subtracting all of the liabilities? Now, your balance sheet has an equation, you all. There's an equation that must be true when your balance sheet is created. And the equation is assets equal liability plus equity. So what is this saying? This is stating that when all of the information is put on your balance sheets, when you add your liability and your equity up, they must equal your assets. If you're creating manual balance sheets, or if you ever see your balance sheet where the total assets does not equal the total liabilities plus equity, the formula is off and your balance sheet is incorrect. Let me give you an actual example of this. So let's say we're creating your balance sheet, right? And so remember, we're going to start with your assets. And we're going to list all of your assets. And so let's say we have cash and cash equivalent or your bank account balance of $12,000. And let's say you have an AR balance of $2,000. And maybe you have inventory, money sitting on the floor, of $10,000, right? And so these are all of your current assets that you have listed on your balance sheet, okay? And so what you're going to do is you're going to add this up. It's going to give you a total. And so let's say, what is that? 1, 2, 4. Oops. So it's 24,000. Cool. We have your current assets. Now let's say you have a trademark for example, and your trademark, I don't know, is valued at $2,000, right? So then this is going to be your non-current assets. So that brings your total assets to $26,000, right? So this is one half of the equation. Now we go to your liabilities and your equity. So let's say for your liabilities, you have a credit card with a $10,000 balance. Make this look a little better. Y'all don't be in my comments talking about, girl, work on your handwriting. Okay, credit card of a $10,000 balance on your credit card, right? So we would list that here. And then let's say you have notes payables, or you have some bills, so that's AP, and you have $2,000 worth of bills on the bills that are going out of your company, right? So this is your current liabilities. So we will add that up. So that means your total current liabilities would be $12,000. But we're not done, because remember our equation. Your assets equal your liabilities plus your equity. And so your assets, $26,000. Your liabilities, $12,000. We still have to list what, you all? Your equity, right? And so let's say that your equity, your retained earnings, equals $10,000. Okay, and so then let's say under equity, you have owner's contribution, and that is $4,000. So that brings your total equity to $14,000, right? So now we have our total assets, we have our total liabilities, and we're just going to say, I put current liabilities, but we're going to say you didn't have any long-term liabilities for the purpose of this example. So then we have our total liabilities of $12,000, our total equity of $14,000. When we put these two together, that makes $26,000. And so now we bring everything together, looking back at our formula. And remember, our formula is assets equal liabilities plus equity. We know that our assets came to $26,000. We know that our liabilities came to $12,000. Our equity came to $14,000. And so now our formula actually match. Assets absolutely equals liabilities plus equity. Now your balance sheet makes sense. Now the formula is correct. Now you can go back and you can look at your numbers and you can say, oh my credit card is $10,000. That is too high. Why were these bills not paid as of the date of our balance sheet, which the date, going back here, December 31st, 2025. Why did you have bills not paid by then, right? You can ask yourself that question. You can say, well, in AR, I have $2,000 that has not been collected on. Why? Let me go and collect that money. You can also look at this and you could say, okay, so I have a cash or cash equivalent or bank balance of totaling $12,000. I have liabilities totaling $12,000. But what if your liabilities were more than your cash balance? Then I would say you're operating your business upside down. You have too much in liabilities, and maybe that's where your money is going. And so your liabilities are not going to be on your income statement. They're going to be on your balance sheet. But your income statement may show that you're profitable, but then you log into your bank account and you don't have no money. That is because it's going out in other categories that may not be on your income statement, but they're taking cash out of your business. Like, for example, your AR, it didn't come in. Your inventory, maybe you bought that inventory, but now it's just sitting on the floor. You need to collect that money. You have payables of $2,000, a credit card balance of $10,000 for the purpose of this example. And let's say if you were actually taking money out of your company, right? Maybe you're an LLC, and so you shouldn't be paying yourself as a W-2, but you are making transfers and you are writing a check to yourself. So that's money coming out of your company that should not be on your income statement, but it is on your balance sheet. And so I hope you are seeing how you can be profitable on paper, but yet that money doesn't flow to your bank account because you have other things, other contributing cash factors going on in your business, and you're not going to know about these unless you look at your what? Your balance sheet. So do you see how your balance sheet in connection with your income statement is just as important? Because it's going to give you the true financial health, not just your revenue, your expenses, but what are the things affecting your cash? And cash is your business's superpower. Does this make sense? Let me know in the comments. Listen, again, I'm not just talking to myself. This is a dialogue, okay? Talk to me and let me know if this makes sense. Let me know what questions you have, what lessons you learned from this episode, and always never forget to subscribe and like this episode. And again, comment on this particular episode. I want to hear from you, all right? So this is Octavia Conner with another episode of the Say Yes to Profits podcast. Thank you for tuning in to another episode of the Say Yes to Profits podcast. Now it is time for you to make money moves. Take action based on what you learn. Now see you on the next episode. Say Yes to Profits. Toodles.